Module Overview. Module 8 of the course, Creating a Business Budget, focuses on one of the most critical and strategic aspects of financial planning, financial reporting, and performance monitoring. After a budget has been created and implemented, it must be monitored closely and analyzed through detailed reporting to ensure that the business remains on track. This module explores the tools, standards, and methods used to generate financial reports and monitor performance metrics, interpret variances, and implement corrective actions. This module is intended to provide a deep, practical, and comprehensive understanding of how businesses use financial reports to maintain control, ensure compliance, enhance decision-making, and improve financial outcomes. Introduction to Financial Reporting. Financial reporting is the process of communicating financial information through structured documents and statements. It helps stakeholders, including business owners, managers, investors, and regulatory agencies, understand the financial position and performance of the company. 1.1 Purpose of financial reporting: evaluate financial health and performance, ensure accountability and transparency, assist in strategic planning and budgeting, comply with statutory and regulatory requirements, facilitate comparisons with past performance and industry benchmarks. 1.2 Key financial reports: income statement, profit and loss statement, shows revenues, costs, and expenses over a period, provides insight into the company's profitability. Balance sheet: a snapshot of assets, liabilities, and equity at a specific point, reveals the financial stability of the business. Cash flow statement tracks the inflow and outflow of cash, vital for understanding liquidity and operational efficiency. Budget versus actual report compares planned, budgeted figures with actual performance, highlights areas of variance, and facilitates timely adjustments. Performance monitoring and analysis. Monitoring performance is about comparing actual results against the budget and identifying trends, issues, and areas needing intervention. It involves tracking key performance indicators, KPIs, and financial metrics. 2.1 Common financial KPIs: gross profit margin, revenue, cost of goods sold, revenue net profit margin, net profit, revenue operating expense ratio, operating expenses, revenue accounts, receivable turnover, net credit sales, average accounts receivable current ratio, current assets, current liabilities. 2.2 Budget variance analysis. Variance analysis involves assessing the difference between budgeted and actual figures and determining the reasons behind it. Favorable variance: actual revenue is higher or actual expense is lower than budgeted. Unfavorable variance: actual revenue is lower or actual expense is higher than budgeted. Causes of variances: changes in market demand, operational inefficiencies, unexpected expenses, poor forecasting economic conditions. Performance monitoring and analysis. Monitoring performance is about comparing actual results against the budget and identifying trends, issues, and areas needing intervention. It involves tracking key performance indicators, KPIs, and financial metrics. 2.1 Common financial KPIs: gross profit margin, revenue, cost of goods sold, revenue, net profit margin, net profit, revenue operating expense ratio, operating expenses, revenue accounts receivable turnover, net credit sales, ISTIS, average accounts receivable current ratio, current assets, current liabilities. 2.2 Budget variance analysis. Variance analysis involves assessing the difference between budgeted and actual figures and determining the reasons behind it. Favorable variance: actual revenue is higher or actual expense is lower than budgeted. Unfavorable variance: actual revenue is lower or actual expense is higher than budgeted. Causes of variances: changes in market demand, operational inefficiencies, unexpected expenses, poor forecasting economic conditions. Interpreting financial reports. Interpreting financial reports involves more than reading figures. It requires drawing meaningful insights that influence decision-making. 3.1 Ratio analysis. Liquidity ratios, e.g., current ratio, quick ratio. Profitability ratios, e.g., return on assets, return on equity. Efficiency ratios, e.g., inventory turnover, asset turnover. Solvency ratios, e.g., debt to equity, interest coverage. These ratios allow businesses to measure their ability to meet short-term obligations, how efficiently they utilize resources, profit generation from assets, long-term financial viability. 3.2. Trend analysis compares financial data across multiple periods, helps detect patterns, seasonality, and performance shifts. Useful for projecting future performance and strategic planning. 3.3. Benchmarking compares business performance against industry standards or competitors. Identifies areas for improvement and competitive advantages. Tools for reporting and monitoring. Modern tools and platforms help automate financial tracking and reporting. 4.1. Accounting software. QuickBooks, Xero, Sage, FreshBooks offer real-time dashboards, automated variance reports, integrated financial statements, KPI tracking and alert systems. 4.2. Business intelligence tools, Power BI, Tableau, Zoho Analytics. Visualize complex data using dashboards, automate performance monitoring, share reports with stakeholders. 4.3. Spreadsheet templates, useful for startups and small businesses. Customizable and inexpensive, must be maintained carefully to avoid errors. Implementing corrective actions. Monitoring performance isn't enough. Businesses must act on what they learn. 5.1. Budget revisions. Adjust budgets based on actual performance and changing conditions. Reallocate resources to high-performing areas. 5.2. Cost control strategies reduce non-essential spending. Negotiate better terms with vendors. Improve operational efficiencies. 5.3. Revenue enhancement tactics. Launch marketing campaigns to boost sales. Diversify products or services. Adjust pricing strategies based on performance data. Compliance and ethical considerations. Businesses must ensure their financial reporting is compliant with laws and standards such as Generally Accepted Accounting Principles, GAAP, International Financial Reporting Standards, IFRS, Corporate Governance Regulations, tax reporting requirements. Falsified or misleading reports can result in legal penalties and damage to the company's reputation. Transparency and accuracy are non-negotiable pillars of ethical financial management. Summary. Module 8 has provided a deep exploration of financial reporting and performance monitoring, two vital components of effective budgeting. You've learned about key financial statements, how to interpret them using ratios and trends, and how to act on performance insights. You've also gained knowledge of the tools and ethical standards that underpin reliable financial reporting. Understanding and implementing sound financial monitoring practices ensures that your budgeting process remains responsive, realistic, and aligned with strategic business goals.